Hello, everyone, and welcome to the second session of the second day of the Modern Investor Summit. So I'm Reda Farhan, Global Markets Analyst at Finimize, and I'm joined today by a very special guest. We have Wayne Thorpe, Head of Research and Analysis at the American Association of Individual Investors. Wayne has worked at the association since 1997, and he's part of its executive leadership team, helping craft its policies and initiatives. As head of research and analysis, he's also tasked with developing new products and services to help investors achieve their financial goals. And very excitingly, Wayne is with us today to show you how to screen stocks like a pro. Wayne, thank you so much for being here. How are you doing today?
I'm doing very well, Retta. Yourself?
All good. We're very excited for this session, actually.
As am
Before
I.
we get started, we just want to go through some kind of housekeeping rules. So, first of all, I want to say a huge thank you to our summit session partner, the American Association of Individual Investors. So, the American Association of Individual Investors is an independent, nonprofit corporation formed for the purpose of assisting individuals in becoming effective managers of their own assets. And they do this through programs of education, information, and research. Second of all, if you haven't already done so, please introduce yourself in the chat box. Put your name, where you're tuning in from. Let's try to make this social. And then third of all, the format of the session will be a 20-minute presentation by Wayne, followed by 10 minutes of audience Q&A. So please don't forget to ask your questions in the Q&A box below. Lastly, if you're posting on social media or on LinkedIn about this event, please remember to use the hashtag Modern Investor Summit. So, with all of that out of the way, Wayne, the floor is all yours. Please take us away.
Thank you. And thank you, everyone. Well, and welcome to this session on how to screen stocks like a pro. As Retta said, my name is Wayne Thorpe, and I'm head of research and analysis products at the American Association of Individual Investor. My goal today is to provide an overview of stock screening and highlight some of the resources AAII offers its members to become managers of their assets and portfolios. After meeting and speaking with thousands of investors over my career, I know that not everyone is cut out to analyze and choose individual stocks or manage a portfolio of stocks. And there's no shame in that. That's one reason why mutual funds and ETFs are so popular. You're much better off recognizing that right off instead of learning the hard way. Perhaps the most daunting question when investing in individual stocks is, where do I start? This isn't surprising, given that there are several thousand stocks to choose from in the US alone. However, there is a solution that can save you time, help you identify quality companies, and remove emotion from your investment decision making process. And that solution is fundamental stock screening. For over 25 years, I've been creating and testing quantitative stock screens and have built multiple portfolio selection and management systems using rules based approaches. Stock screening is the process of filtering individual stocks that meet specific financial requirements. By thinking about the types of stocks that fit your needs as an investor and your overall portfolio, you can shape the criteria you use for identifying stock candidates. However, arguably, the most critical question to answer, and to answer truthfully, is whether you have the patience, discipline, and temperament to analyze and select individual stocks and manage a stock portfolio. No matter the criteria you're using when screening for stocks, it is essential to remember that stock screening is only the starting point. It is a stepping off point, not the finish line. The only thing we know about a list of stocks passing a stock screen is that they share the same base minimum criteria used to create the stock screen. Companies passing a stock screen are not necessarily suitable for you. It's up to you to perform sufficient analysis to make that decision for yourself. A well designed screen will reduce the universe of thousands of stocks to a more manageable handful you can focus on and do the necessary due diligence before investing in them. Some of these companies may be outside the scope of your typical investigation, so screening can broaden your investment opportunities. Beyond this time saving element of stock screening, it can also bring discipline to your investment process. A lot is said about discipline when discussing successful investors, and you shouldn't underestimate its importance. Identifying a stock screening strategy that suits you requires honest self reflection to determine your investment style. Adhering to a stock screening approach also helps you keep your emotions in check when the market turns volatile. Letting the parameters of the approach dictate your buy and sell decisions can help you avoid potentially questionable investments and from selling too quickly or at inopportune times. The number of quantitative screening strategy possibilities is endless. However, academic research and real world experience show that there is a set of elements or characteristics underlying many successful long term screening methodologies. Over long periods, value does tend to outperform growth. So, approaches that emphasize low valuations to earnings, revenue, or book value tend to be successful. The caveat here, however, is that many companies with low valuations have issues that the market is discounting. In other words, the low valuations reflect the market's opinion of the company not having good prospects. So, when screening for value stocks, secondary criteria that identify elements of financial strength are critical. When screening for growth, you're better off looking for consistent, sustainable growth. Looking for the highest growth will oftentimes lead to some of the worst performance. Instead, look for growth that a company can maintain throughout the business and economic cycle. Companies that have a unique niche, such as a unique segment of customers, specialized products or services, geographical focus, or technological innovation, often generate above average profit margins. A company with strong financials is well positioned to endure economic downturns, invest in growth opportunities, and provide above average returns for its shareholders. Looking across the balance sheet, income statement, and cash flow, companies with strong financials tend to have robust and steady revenue and earnings growth, healthy profit margins, a strong balance sheet with low debt levels relative to assets and equities, positive cash flow, and liquidity and solvency. On its own or paired with value, stocks that exhibit strong price momentum tend to carry that momentum for as long as a year. Significant earnings revisions and positive earning surprises, especially among low valuation stocks, can lead to profitable results, especially if they trigger a change in the market's overall perception of the company. And lastly, having a disciplined investment approach is crucial to success, and I will touch upon that more towards the end. For someone who's been performing quantitative stock screening and analysis for over a quarter of a century, it's easy for me to say that the concept and implementation are relatively straightforward. Unfortunately, many investors I've spoken to over the years don't utilize stock screening because they think it's too complicated. But I respectfully disagree. In fact, some of the most simplistic screening strategies can actually be the most profitable. One such example is AAII's model shadow stock portfolio. This is one of the longest running rules based portfolios that I'm aware of. AAII has used this approach, with only a few changes, to manage a real money portfolio since 1993. The portfolio follows AAII's belief in evidence based investing. It's rooted in the research of Eugene Fama and Kenneth French, who discovered that, over long periods, microcaps and deep value stocks tend to outperform larger, higher valuation stocks. Over the research period from July 1963 to December of 1990, Fama and French found that stocks in the deciles with the smallest market cap and lowest price to book ratio outperformed those in the top deciles. And by investing in the intersection of smallest market cap and lowest price to book value, the results were even more impressive. This is what led AAII's founder, Jim Clunan, to launch the model shadow stock portfolio. For individual investors, these findings are incredibly encouraging. This segment of stocks is where only individual investors can invest and outshine institutional investors. This has become the realm of microcaps offers retail investors a unique opportunity where big money cannot venture. Unlike institutional investors, such as mutual funds or pension funds, individuals can take positions in microcap stocks without distorting the price. Here, individuals compete with one another, not Wall Street research departments or high frequency traders. For just $49 a year, AAI members can access the model shadow stock portfolio and receive quarterly portfolio reviews. The portfolio is designed to require only a few hours of analysis each quarter. The buy and sell rules are clearly defined and easy to follow. This is not a black box system. At its heart, the model shadow stock portfolio approach focuses on three key elements: a market cap that ranks in the bottom 10% of all New York Stock Exchange stocks, which is currently less than $300 million, a price to book value ratio that ranks in the bottom 10% of the NYSE stocks, which is currently less than or equal to zero point 0.9, and lastly, positive earnings from the latest fiscal quarter in trailing 12 months. Now, the maximum levels for market cap and price to book will adjust as the market moves up and down. The approach is designed to let both the company and its price to book value ratio grow, which comes from price appreciation. A stock is removed from the portfolio if its market cap or price to book ratio goes above 3 times the initial criteria. We also remove a company if its trailing 12-month earnings go negative in one quarter and the company reports negative quarterly earnings in a subsequent quarter prior to the trailing 12-month earnings turning positive. Remember when I said earlier that an investment approach doesn't have to be complicated to be successful? Well, since its inception in 1993, the model shadow stock portfolio has generated an average annual return of 13.2% compared to the S&P 500's return of 9.6%. This means that $10,000 invested in the portfolio at the start of 1993 would have grown to more than $463,000 at the end of October versus nearly $170,000 had you invested in the same amount in the S&P in the Vanguard S&P 500 fund. The success of the AAII model shadow stock portfolio is just one example supporting the case for microcap stocks. Microcaps also dominated small and large caps over 20-year rolling periods from the end of 1945 through the end of last year, according to data from Duff and Phelps and FactSet. Looking at an even longer time frame, microcaps outperformed large caps by roughly 200% between the start of 1926 and the end of last year. AAII understands that there's no such thing as one size fits all investing. For that reason, and for over 30 years, we've been tracking 60 or so stock screening strategies based on common investment factors and the approaches of many of Wall Street's most successful investors. These idea screens are a great place to start if you are new to stock screening, looking for an approach that suits your investment style, or just looking for a diverse collection of investment ideas. AAI identifies key underlying factors for each screen, such as value, growth, momentum, and earnings estimates. For each screen, we also provide an updated passing companies list after each trading day. We also track the simulated performance of each approach, assuming monthly rebalancing and equal dollar investments in each passing company. It is important to point this out that the results that we report for our idea screens are based on simulated or back-tested results. There's no real money behind that, unlike the performance that we report for the model shadow stock portfolio and our other model portfolios at the association, which are based on real money, true market experience. AAII also provides a detailed description of each approach. So these screens serve as an educational tool to help investors see what works and what doesn't when building a stock selection strategy. And I think that's very important is to know not only what does work when it comes to investing, but also what doesn't work. So you can avoid, those missteps that historically have led to poor performance. Now, I've only scratched the surface of the stock screening resources AAII provides. These include online and software based screening tools and premium model portfolios based on evidence based, rules driven strategies for real world portfolios. Before I wrap things up today, though, I do have a few final thoughts. First, it's essential to recognize that no factor or investment strategy will consistently outperform the market or make money. They go through cycles just like the market, the economy, or individual companies. However, it's equally important to remember that if you want to beat the market, you have to invest differently from the market. Otherwise, you're better off buying a broad market index fund. There will be times when factors and strategies will come into and fall out of favor. Just as you diversify your portfolio across different asset classes, sectors, and industries, so too is it a good idea to diversify your strategies. I cannot stress enough how important it is to do an honest self evaluation before investing in individual stocks. Experience has taught me that to succeed with an individual stock selection strategy and investing in stocks in general, you must have enough time to manage a stock portfolio. I think some people underestimate the time that it takes to manage or analyze individual stocks. So, that is one thing that you really need to keep in mind. You also need to have the ability to manage diversification across a portfolio. Diversification is very important. Again, that's whether or not you're investing across sectors or industries or strategies. Diversification is important. And lastly, you need the interest in managing a portfolio. Managing stocks, the performance of some of these stock screening strategies look very enticing, but you have to have the interest in managing a portfolio. I've met a lot of people that said, had the best intentions of wanting to invest in individual stocks, but they found it just didn't do anything for them. They didn't have the interest, they got bored, and if they become disinterested, that's oftentimes when performance starts to flag. It's also important to say again that fundamental stock screening is only the first step. Stock screening is an efficient way to narrow the universe of thousands of stocks to a manageable handful that you can focus on and analyze in depth. But any passing companies list is not a buy list. It's simply an ideas list that requires cultivating before deciding whether to buy any companies. Lastly, if you're to look up the top investment gurus over the years, most, if not all, share one common trait. They are disciplined in their investment approach. One thing I know is that emotion can wreak havoc on your discipline and investment performance. So, how do we become more disciplined investors? It all starts with creating a plan. Regardless of your approach or strategy, a plan has to be in place. Without one, it's very easy for emotions to take over and lead you to make risky or foolish investment decisions. Of course, having a plan only works if you follow it, and that's where proper discipline comes into play. Now, I'll admit, this is much easier said than done, especially when it seems like the market has gone off the rails. Many investors succumb to FOMO, or fear of missing out, when markets are hot and abandon their plan to chase the current fad. And when the market falls, others panic, sell too quickly, and stay on the sidelines too long after the market rebounds. Discipline comes through confidence in the system or strategy you follow in both up markets and down. If you want to learn more about AAII and the educational and screening resources we provide, we're offering a special discount to conference attendees. And you can go to the URL on the top of the slide, invest.ai.com/premium hyphen products, or you can contact me directly at wayne@aaii.com. And with that, I want to thank everyone for attending today, and let's open things up to questions.
Amazing. Thank you so much for that, Wayne. And actually, we do have quite a few questions coming in. And if we also have time, I have some questions myself. But let's start with the audience Q&A first. And the first one is basically asking, where do you do this stock screening? So, of course, you mentioned AAII. Is that the resource you recommend? Are there any others you potentially recommend?
One thing I've noticed is over the years, the number of screening services available to retail investors has really declined, or at least the quality has. AAII actually has a software package called Stock Investor Pro, and I admit I probably may be a little biased, but I think it's arguably one of the most powerful stock screening tools out there available for retail investors or individual investors. It offers a universe of roughly 7,000 companies, roughly 2,200 screening points per company, and you can run screens pretty much any which way you want. You can actually even create your own custom variables. But that is the tool that we use internally when we're either just for our own screening, or if we're developing new strategies. That is the tool that we use, Stock Investor Pro.
Amazing. And this is kind of related to a question we have over here as well, which is basically kind of what markets does AAII operate in? So this universe of stocks that you're discussing in your stock screener is only US stocks, is it global stocks?
Our primary focus are U.S. listed stocks. So so there, you have a universe of probably about 300 or 400 ADRs and whatnot. But our focus are those stocks that do trade on U.S. exchanges.
Okay, amazing. And a related question from one of the members from the audience is it possible to become a member at AAII if he or she lives in the UK?
Absolutely. We probably 95+% of our members are based here in the States, but I do know for a fact and have spoken to people literally from around the world. So if our resources can benefit you, an investor, wherever you are, then you're more than welcome.
Yeah, absolutely. I mean, the US is what, 50% of global
Mm.
equities by market cap. So I'm sure everyone's looking at US stocks, right? One way or another. Okay, amazing. And we have one question basically saying, what indicators in the screening process do you recommend for selecting growth stocks? So I know, Wayne, you touched on growth earnings consistency, but what else do you recommend for this person when it comes to screening for growth
Well,
stocks?
actually, growth has a special place in my heart because last year I launched a growth-oriented investment approach, and I did a lot of research on that. And I touched on earlier, it's for the growth that for the analysis that I was looking at, I was actually primarily looking at top line growth, so revenue growth. Earnings growth, in my opinion, is very easily to manipulate. So sales, you can still, stuff channels, things like that. There's some manipulation that can take place even for sales figures, but it's much less apt to be manipulated versus earnings. There's just so many assumptions, and management has so much leeway, even within GAAP standards, to really, quote unquote, manipulate earnings, and that necessarily isn't a bad thing. They're just able to do that under the rules. So I look at top line growth. Also look for consistency of year over year sales increases, as well as year over year positive cash from operations generation. So revenue and cash from operations, a companies that are profitable from an earnings standpoint are still going to fail if they're not generating adequate cash. So top line growth and cash from operations are definitely two elements that I look at closely when I'm evaluating growth stocks.
Yeah, absolutely. Earnings can be fudged with a lot of accounting shenanigans, but cash is
Absolutely.
king, right? As the saying goes.
Absolutely. Absolutely.
Amazing. And one question from Michael is basically how much time per week do you suggest is needed to manage your own stock portfolio?
That's I might take a cop out answer. It depends on how many stocks you have. But it's dependent on what elements you're looking at when you're deciding to remove a stock. Um, you know, I had 20 minutes. I've literally given this presentation in day-long seminars, so I had to gloss over a lot of things. But when you're looking at an approach on the sell side of things, what I often suggest doing is basically flipping the criteria that you used to buy the stock and use that on the sell side. And so if you're looking at true financial statement data to make a buy decision, that data is not changing day to day or even week to week. If you're using quarterly or trailing data, that's going to be updated uh, basically at once every 90 days when a company files new quarterly financials. Or if it's more annual based, then that's not changing on an annual basis. So if your approach is more financial statement data driven, such as the model shadow stock portfolio, really you don't have to be looking at things much on a week to week basis. If you do, you're more apt to start tweaking things, and that's when the process can maybe start falling apart. Now, if you're a momentum oriented investor, then you're going to be wanting to be looking at probably day to day, even minute to minute potentially. So it really is driven by the aspects or the characteristics you're looking for in the stocks when you bought them in the first place, and that will dictate the how often or how closely you have to be monitoring these stocks.
Yeah, that makes perfect sense. And the next question I was pretty sure was going to come up eventually. And the question is, do you use AI for stock screening?
I do not use AI for stock screening. I'm sure at some point it will. I mean, I use AI for a lot of things. I think it's great for like summarizing articles and things like that. But I still have also found where it can be not so accurate. Actually, on a lark about 6 months ago, I asked it to write a bio for me, and it said that I'd passed away. So obviously, there's still some bugs to be worked out in the system, and if it can't, if it can incorrectly identify whether or not I'm still alive or not, I definitely wouldn't want it necessarily to be helping me when I'm investing my hard-earned dollars at this point. I'm sure it will reach a point where it will be much better, but I still a little questionable at this point.
I'm sure OpenAI have a customer feedback form that you should probably fill out. That'll be the biggest proof that you're still alive. So,
Absolutely.
okay, amazing. And we have a pretty good question, which is basically asking what screening indicators do you use to find high dividend stocks or income stocks?
So obviously you're probably looking for high yield. So dividend yield is going to be really the cornerstone of your approach. Even then, though, we have a dividend portfolio here at the association, but we don't necessarily look for absolute yields. We're looking for more companies that have dividend yields that are attractive to either sector industry norms or longer term averages for the company. So that presents an opportunity that the yield will grow over time. But then when you're also dealing with income oriented stocks, you want to make sure that you're also adding these qualifying elements that make sure that the dividend is protected. So looking at cash flow would be important, probably more so free cash flow, because it's from that free cash flow that the company is really going to be. That's cash after cash from operations after a company is taking care of its capital expenditures, and so that's basically the real cash that's left over that will allow them to do buybacks, either pay or boost dividends, etc. And then you also probably want to be looking at the payout ratio. If a company is already paying out, 100% of its earnings, even though cash dividends come from cash and not earnings. A lot of companies have debt covenants and whatnot that might limit their ability to be paying a dividend much higher. So you want to be looking at things like payout ratio that are indicative of the company's ability to be boosting its dividend going forward.
Amazing. And one question on so if an investor doesn't want to replicate the model shadow portfolio by buying and selling all the individual stocks, is there an ETF that automatically tracks this portfolio?
No, because the stocks, as I touched on, the stocks that the strategy identifies, that's the arena for the individual investor. An ETF or a fund with any pool of money trying to move into or out of these stocks would basically become the market in those stocks, and would lead to significant price distortion. So this is an arena where you have to have that interest to manage a portfolio yourself, but then that's also the arena where you have the advantage and don't have to be you aren't competing against the Wall Street heavyweights.
Amazing. And I have one burning question from my side, just on the practicalities of forming a stock screen. And basically, is it do you use kind of absolute or relative numbers? So what I mean by that is, let's say you wanted to include price to earnings as a ratio, right, in your stock screen, and you wanted to filter for, cheap stocks. Do you set the screen filter as, hey, find me stocks with a PE of under 15, or do you look at it relative to the market PE? So, hey, find me stocks are trading at a 20% discount to the market PE.
That's an excellent question, and I would say no matter what, more often than not, I'm using relative approaches. Actually, I use percentile rankings a lot because those rankings and those cutoffs will fluctuate as the market moves. So yes, I would personally, I would never run a screen, yeah, to give me stocks that have a PE less than 15. I would probably more apt to say, show me stocks that are trading at 80% of their 5-year average or rank in the top and the bottom 20% of the stock universe. So absolutely absolutes are the way that I would suggest screening for variables like that.
Okay, makes perfect sense. That's my question answered. And I'm afraid we're also out of time, but that was amazingly helpful, very informative. Thank you so, so, so much. Thank you, everyone, to our fantastic guest, Wayne, and thank all of you for tuning in. I really hope you enjoyed that and you can take something away from this session. Wayne, thank you so much.
Thank you. I had a wonderful time. I always enjoy doing this. So thank you.
Thank you. And everyone, don't go away just yet, because next up we have another session, which is 2024 Outlook, Navigating the Year Ahead, featuring an all-star lineup, including Liz Ann Saunders, Chief Investment Officer, strategist at Charles Schwab, Michelle Mayer, Chief U.S. Economist at MasterCard, and Karen Ward, Chief Market Strategist at JP Morgan Asset Management. So that session is at 2:30 GMT, which is roughly 12 minutes from now. So be sure to stay tuned as we still have lots of merchandise and surprises throughout the day. So make sure you're attending every session to win something throughout the day. Thank you so much all for attending. Thank you once again, Wayne, and see you all in the next session.